Hello, this is Chuck Self, Chief Operating Officer of iSectors. I wish to introduce you to Scott Jones, our Director of Business Development. Scott has led our sales and marketing efforts since iSectors' inception in 2008. Today, he is describing to you how to present our 4 simple ways to improve investment results brochure to clients and prospects. The main presentation will be 10 minutes in length, followed by a question and answer period after the presentation. If you have a question, please type it into the box at the bottom right-hand side of the screen. With no further ado, I will now give you Scott Jones.
Thank you, Chuck. Before I get started, seeing how this is the holiday season, I'd like to wish everyone happy holidays and hope you all have a very prosperous 2016. What I'd like to accomplish today is review with you a one-page marketing piece that you can see on your screen that I would like to review with you and give you some talking points that you may want to share with some of your clients to help explain what's going on inside the post-MPT strategies. This is an abbreviated version. So if you're interested in a more in-depth analysis and explanation of the strategy, I would suggest participating in our webinar immediately after this at 3:15 Central Standard Time, where I will go into more detail. But the way to start out explaining this to a client, basically, to give you some history, the reason we call these models post-MPT models is what we're trying, in post-MPT stands for postmodern portfolio theory. So we're trying to convey the fact that this is a more advanced approach or application of the principles of modern portfolio theory. And a good way to explain this to a client is basically where this strategy is going to help them improve their investment returns with less risk over a complete market cycle. And what we're doing with the strategy is we're basically implementing 4 improvements to the way traditional modern portfolio theory is applied. Number 1, we allocate our portfolio to asset classes that have much lower correlation to one another. As you will know, most investment advisors have historically allocated portfolios amongst your capitalization style-weighted asset classes, your large, mid, small cap, growth value, and core asset classes. And as you well know, these asset classes have become very highly correlated over the last 20 years, and they're starting to converge on one. And in a down market, when you really need diversification to reduce risk, they actually do converge on one. And you see that anytime the market goes down. So these asset classes really don't uncover the benefits of diversification. So back in 2004, when we developed these models, we did extensive correlation analysis, and we took the same universe of stocks and bonds that are represented by your domestic cap style weighted asset classes, and we identified 9 asset classes that you can see here on the chart. And these asset classes were chosen because they had the lowest correlation to each other, and thus the allocation is able to uncover the full benefits of true diversification. And you can see in the left-hand column there what those asset classes are: basic materials, energy, financials, healthcare, real estate, technology, utilities, bonds, and gold. And intuitively, you can look at those asset classes and see that they are truly very different from one another. So that's the first improvement that we make. The second improvement that we make is the algorithm that we use is an objective, quantitative, rules-based algorithm. As you well know, the mean variance optimization algorithm requires you to determine the expected returns of various asset classes, which is basically guessing. It's very subjective. You're either guessing mean reversion or momentum. So, our research has shown that it would be much more effective to determine the optimal portfolio allocation on the efficient frontier by using more objective factors. So as a result of extensive research, we've identified 15 proprietary capital economic factors that we found to have a very high impact on asset class returns. All these various factors have different lead lag times, which our algorithm is measuring. But by utilizing factors such as interest rates, capitalization, money supply, GDP, unemployment, and so forth, we can the model is able to use this data to help determine a more objective allocation on the efficient frontier. Third improvement that we make is that we use a better definition of risk. As you well know, the traditional measure of risk is standard deviation. Well, unfortunately, standard deviation is flawed because it assumes both upside and downside volatility to be equally as bad. And as you well know, most people don't look at excessive upside volatility or the chance of making unexpected returns as bad. I mean, that's a good thing. Most people look at, unexpected losses or losing money to be bad. And standard deviation, unfortunately, is not able to measure that. Standard deviation assumes that all investments have a perfectly symmetrical return distribution or an equal chance of making unexpected returns and unexpected losses. And obviously, that's not true. As you know, most investments have skewed return distributions either positively or negatively. So by using don't go below zero as your measure of risk, which is measured by negative semi-variance, our model only focuses on investments that have a greater chance of generating positive returns, and it eliminates all investments that have a greater chance of losing money from the universe. The fourth improvement that the model makes is that it reduces your investment vehicle costs. By using ETFs instead of actively managed mutual funds, which traditionally are used in a portfolio allocation, you can reduce your investment vehicle cost by 2 to 3%. And to break that down exactly where those cost savings are coming from, you can see that indicated on the bottom of the page here. ETFs do not have management fees like actively managed mutual funds do, which can range anywhere from 1 to 1.5%. ETFs do have administration fees, though, that can range anywhere from 0.07 to 0.7%. But as you can see, it's significantly less than having to pay a manager. And mutual funds or ETFs don't have transaction costs like an ETF or like an actively managed mutual fund does because it's representing an index. So that can save you anywhere from 0.5 to 1%, which is on average the cost of most of the trading going on in an average actively managed mutual fund. And because there's no trading going on inside an ETF, ETFs don't have pass-through capital gains taxes to pay like your traditional average actively managed mutual fund does. And this cost can range anywhere from 0.5 to 1.5%. So as you can see here at the bottom, the cost savings by using ETFs versus actively managed mutual funds can be anywhere from 2 to 3%. And when you compound that over 10, 20, 30 years, that is quite substantial. So to summarize what the model is doing, the model is rebalanced on a monthly basis. Every month, what we do is we collect the inputs from these 15 different capital economic factors. We input that data into the algorithm, and we tell the algorithm, based on the change in these 15 different capital economic factors, how should we allocate the portfolio in such a way to take maximum advantage of upside volatility without going below zero? And then the model will give us an allocation amongst these 9 asset classes with restrictions that allow the model to only allocate up to 30% in any one of the 9 asset classes, except for bonds. Bonds can go up to a maximum of 50%. And the difference between our post-MPT growth and moderate allocation is that the post-MPT growth can use up to 33% leverage in any one of these 9 asset classes if it feels that it can generate more outperformance without taking on any additional risk. And we get our leverage using 2-time ETFs. We don't use any borrowed money. So in summary, the post-MPT models, number one, we use a more advanced, enhanced algorithm to create the efficient frontier. We use a better definition of risk. We use don't go below zero instead of standard deviation. And then we also allocate the portfolio to a universe of asset classes that are truly unrelated to one another. And then finally, we reduce investment vehicle costs by using ETFs versus actively managed mutual funds. So I want to thank everyone for joining the webinar today. If you have any questions, feel free to submit them online, and I'd be more than happy to answer them. Thank you.
Thank you, Scott. Again, as Scott indicated, If you have any questions, please type them into the box at the lower right-hand side of the screen, and I'll be asking Scott the questions as they come in. We already have 2 questions that have come in, and so we'll start on the question and answers. 1, what kind of gold ETFs are used in the model?
Good question. We use the gold stock ETF. We don't use the gold bullion ETF. It's the gold stock ETF.
Okay, very good. The second question we have is, are you using short bonds or long bonds or both?
We use 20-year treasuries as our bond allocation.
And they're all long bonds.
Right, long bonds. That's correct.
Okay. And the third question we have so far is this chart available to us? And then the fourth one, can you email the handout used? And the answer to that is, and I was just getting ready to tell you that we are going to email you the chart that was in front of you, and we're also going to give you a link to a recorded copy of this webinar, so that whenever you have a client or prospect that you would like to use the chart, you can do so, and then you could go over Scott's comments beforehand and be able to explain the chart very proficiently. Are there any other questions? Seeing none, I want to thank you for being with us today. As I indicated, we will be sending you a link to the recorded copy of this webinar, along with the 4 Simple Ways brochure that Scott went over to your email. If you have any further questions, please contact us at 800-869-5164. That's 800-869-5164. Thank you very much for attending the webinar. Have a happy holidays and a prosperous new year.